Thank you for taking the time today. My name is Julia Cummings, and I'm a Senior Wealth Advisor for Beacon Pointe in the Los Angeles office. I am joined here today by Fred Giron, an Account Executive for Acrisure, a 14-year Financial Planning Association Orange County member. He specializes in P&C products using a variety of different carriers. He's truly an expert in the field and someone we've used at Beacon Pointe as a trusted resource for many of our clients. I'll start today by saying, the beginning of this year has certainly brought challenges with unprecedented fires impacting many of our clients, friends, coworkers. Even if you weren't directly impacted yourself, it's certainly likely touched someone within your inner circle, and it's pulled to the surface a deeper desire to truly better understand where blind spots might be. So for those that are listening and you're a client, you already know our all wealth approach is meant to bring alignment with what matters most to you. And sometimes it's that uncertainty that can get in the way of truly understanding and enjoying what you've worked so hard to achieve. For those who are joining who are less familiar, please know we make it our mission to provide you with support and peace of mind so you can rest easier at night. And this webinar is one small example of how we do that. So let's dive into the agenda for today. The goal is simply to help you better understand and feel confident in what your homeowner's insurance covers, what the most important terms mean, and to leave you today with a few important takeaways and action steps. We have a lot to cover, so we've put together a list of common questions, and that will serve as a foundation. And hopefully you leave here feeling a bit more informed. As Fred is talking, please feel free to write into the Q&A box that's below on your screen, and any additional questions that we don't have an opportunity to answer live today, we will reach out to you directly to address those questions after the call. So with that said, I will begin by asking you, Fred, one of the most common questions on everyone's mind is simply, do I have proper insurance and is my coverage enough? And for the start, at least, if we can focus on coverage A, or your dwelling insurance, if you will.
Yeah, I'm sure the fires have definitely spooked a lot of people, and people are wondering if they have enough dwelling coverage. So insurance agents, we're not contractors. The consumer is not contractors. So we use software that helps us calculate the replacement cost estimate of residences. It uses variables like square footage, year built, the number of bathrooms. It can vary by zip code, it can vary by county, it can vary by the size of the home. Usually these replacement cost estimates are done at the inception of the policy. Now, what you may want to do just to get a reassurance of things is contact your agent and go over that replacement cost estimate, and you're definitely entitled for a copy of it. And as long as that information is correct, I think you should feel comfortable that the dwelling coverage is sufficient. One thing that I would like to add to that, especially with the fires that have happened, are a little bonus coverage called extended replacement cost. So that replacement cost calculation is based on quote unquote a standalone fire situation. So example, you're cooking and you cause a fire and it causes a total loss. What's been happening, as an example in Pacific Palisades, it's a catastrophic event. So the cost of materials, labor, contractors, everything is going to be substantially higher. So to help with that, there is what's called the extended replacement cost. It varies. It provides, let's say, 25% above the dwelling, 50% above the dwelling. So just to make the calculation simple, let's say the dwelling coverage is $1 million in coverage. 150% extended replacement cost means there's an extra $500,000 in dwelling coverage above that. to rebuild the property. And it's very inexpensive coverage. So that's probably a good tip that just popped into my head right now. Sometimes carrier gives the option to do 125, 150% extended replacement cost. If you have 125 and the option for 150 is available, it's only a few dollars. Get that. It'll provide a lot of extra coverage should you need that.
That's perfect. Thank you, Fred. One of the next sort of common confusion points or questions to clarify here is rebuild cost the same thing as replacement cost? Can you help walk us through the difference between those phrases, if any, and what goes
Sure.
into each of those calculations?
To answer that answer simply, yes, it's the same thing. What tends to be confused is the replacement cost versus the market value of the home. Let's say you take a home down in Newport Beach, just for it's 2,000 square feet. It'll probably sell for maybe $3 million or $2 million. It's some huge number. But if we magically lift this house and take it down to, let's say, Paris, California, nothing wrong with Paris, California, but the market value is going to be a lot lower for that property. But the rebuild, it's going to be fairly consistent. You know, there are some differences, but the labor, the lumber material, it's going to be relatively the same, the exception of those catastrophic events that we talked about earlier. I bring that example to show you that the replacement cost will oftentimes, in California especially, be less than the market value of the property.
Okay. I think you mentioned it a bit earlier. Replacement cost, did you kind of reference a range per square foot that's common? And if not, can you give us an idea of what's typical?
So in the past, we used to do a cost per square footage. That can get us agents into trouble because it's very basic information. But I've seen some planners use, let's say, $350 a square foot to like $300 to $450 a square foot, and that's fine. That'll get you definitely in the ballpark. It might even overestimate in things or underestimate things, but that's definitely get you in the ballpark of the cost estimate. But it is not a substitute for going over that replacement cost calculation, making sure they have the correct things, especially if you've done a remodel, to make sure that calculation estimate is correct.
Okay. And I'm assuming, Fred, is it correct that you can always, of course, go higher than that range if you want to, right?
That
Getting
is
additional
correct.
coverage.
Insurance companies will typically not allow you to go below that, but you can definitely increase that. And I've seen people do that, and substantially higher than the replacement cost estimate, because let's say a neighbor down the street had rebuilt their house and it was substantially higher than the replacement cost estimate. And that's perfectly fine. Increase it to whatever you feel comfortable with. We're talking probably a couple $100 difference or maybe 1,000. But that'll give you that extra peace of mind and provide that extra amount of coverage that would make you feel comfortable, especially in these dire times.
Makes sense. So what happens, Fred, in the event of a total loss? Can you kind of walk us through? So now we're not, what are the options there?
Sure. Before I continue, I'll differentiate between what insurance companies are doing and what they are contractually obligated. So what a lot of insurance companies are doing, if it's a total loss, they are paying out the coverage A limit on the policy. Now, they don't have to do that. So in most typical situations, they will provide payments as the property is getting rebuilt. But what we're seeing now with these catastrophic events is they are paying the coverage A limits. Now on personal property limits, so just to define personal property is if you turn the house upside down, whatever falls out, that would be personal property, like clothing, furniture, stuff like that. They are giving a percentage of that upfront where you don't have to provide proof that you own that items. So the Department of Insurance is requiring at least 30% of coverage A. It'd be a little confusing because we're talking coverage personal property, but they're saying 30% of coverage A, or a maximum of 250,000. So that's contractually what they're required, but I am seeing payments higher than that. I'm seeing they're paying up to 50% at times, and then after, let's say, an interview or just some very basic background information, sometimes they will pay up to policy limits on the personal property. Julie, I believe you're muted.
Yep. Thank you.
Mhm.
That makes perfect sense, Fred. Thank you.
Yeah.
And I believe in the event of a total loss, can you walk us through? I believe there's two main paths that people typically pick between, right? It's rebuilding your home, and then if you choose to actually not rebuild your home and kind of walk away, can you walk us through both those options
Sure.
and how that goes?
Sure. So there is what the contract allows, and then there is what the mortgage company will allow. So by the contract, you can take that money and rebuild someplace else. You can also purchase another property if you like. That's not an issue. But what gets more complicated is when there is a mortgage on the property. The check is made out in both the named insured name as well as the mortgage. And then the mortgage will want to make sure that the collateral that the mortgage is paid or that the collateral is rebuilt. And they're going to be releasing uh, portions of that money as the progress of the home gets rebuilt.
Okay, that makes sense.
Yeah.
Let's expand a little bit more, if we could, on the topic of the mortgage. So what happens if your coverage happens to be less than your outstanding mortgage balance?
Uh, in situations like that, unless there's some creative negotiations with the mortgage company, you're practically going to be forced to rebuild the property because that is going to reintroduce the collateral that the mortgage has. So that's when it's important to have additional living expenses on the policy. So additional living expenses is if you needed to live someplace else while the home was being rebuilt, there's a dollar amount listed on the policy. And I believe Beacon is going to send out a little document that shows kind of what each coverage is, as well as its definitions, so you know where to find this on your current declaration page. But that coverage amount is going to be used to keep you housed until that property is rebuilt. Now, I don't have an answer as to how long it's going to take to rebuild homes in Pacific Palisades. It's going to be a long time, unfortunately. I mean, just the cleanup alone is going to take a very long time.
Sure. And so for people who either lost coverage, just shifting gears a bit here, for people who lost coverage or, were not able to get fire coverage at all, can you help walk us through what the different
Sure.
options are? And, if you can also touch on the California FAIR plan in that response, that would be helpful.
Yeah. So in my occupation, I get calls every day where people are having a difficult time finding coverage. Right now, it's hard finding renters insurance for people that are renting in Los Angeles County. So it's very difficult. Now, if we run out of options, there's the California FAIR Plan. I'll touch on it because it's important. People are very familiar with it. Then I'll go through some alternatives to that as well. So the California FAIR Plan is a quasi-government agency and that is, as long as the house is in good shape, they are required to offer fire insurance on the property. The caveat to that is that there's a maximum dwelling coverage limit of $3 million. I shouldn't say maximum total insured value of $3 million. So let's say you have, to simplify things, you have $2 million in dwelling, $1 million in personal property. You reach your $3 million limit, that's all you get. So this is probably not enough for a lot of the homes that were in Pacific Palisades. Now, there are policies that are excess over that. I will add to that that those policies are very, very expensive. So more than likely, a lot of them were self-insuring above the $3 million in building coverage. Now, aside from the California Fair Plan, there is non-admitted markets. So maybe 3, 4 years ago, when the insurance market was much more steady, non-admitted was kind of like a bad word where you didn't want to go there. But we're writing more and more with them right now, with good, stable companies. Not admitted means they're not regulated as strictly as an admitted company. They can vary different rates. They have contracts which are a bit more flexible in what they can include and exclude, and thus their availability is more predominant in coverage. So those are options to the California Fair Plan. So the surplus line, there's even in very high brush areas, there's policies that the properties that even the surplus lines carriers will not touch. But those are options that you can look at. So what's good about these surplus line companies is that they can often exceed that $3 million in coverage that the Fair Plan cannot meet. And so that's another option to look at. So if your agent does not have the ability to look at surplus lines products, I would definitely call around to see if who has that available, see if it's an option for you.
Fred, just to clarify, is the surplus line, would you get a policy to add on top of the Fair Plan, or would it be a separate policy altogether?
Okay, so there's multiple types of surplus lines products. So there's a surplus line product that works just like a regular homeowner's policy that is a substitute to the Fair Plan, not an extension of the Fair Plan. So just to give like it would replace that Mercury homeowners policy that was non-renewed due to brush. Then there's the excess property policies, which I would try first doing the primary under surplus because it's going to provide broader coverage and it's going to be more cost effective. But there are situations where it's just not possible. And then that's when we can get into the access above the Fair Plan. So that is the last thing that you would want to exercise if you wanted to try that.
Okay, thank you. Can you speak a bit about the Fair Plan, California Fair Plan's ability to pay out claims? Is there any concern from your standpoint about their ability to pay claims?
Yeah. So they don't have a lot of cash on hand, but they have what's called a lot of reinsurance policies. So the term reinsurance means that it's insurance for insurance companies, and they have many, many layers above that. Now, knock on wood, now the loss numbers keep changing, but as of now, I do see the reinsurance being sufficient to cover the current losses. But as time progresses, I just keep seeing those numbers go up. So if they keep going up and it exceeds those reinsurance numbers, there is still another way that they can get money to pay for those claims. And that is by assessing other insurance companies. And then the other insurance companies, they'll need permission, but they can then assess the policyholders. How that happens, if that'll happen, we don't know. I don't even think that's ever happened before. But hopefully the current coverage and the reinsurance policies will be sufficient. What that's going to mean for the future of the California Fair Plan, I don't know.
Right.
I will say just a quick note to the Fair Plan. They are doing the best they can. I know that. But right now we have clients that have called maybe a week ago for a total loss claim, and it's been like a week and a half, and they still haven't gotten a call back from the Fair Plan. I wouldn't worry. I mean, there's just going to be coverage, but they're hiring staff, and they were just not prepared for a catastrophic event. So hopefully they'll remedy some of these problems that they're having with not having the money to pay claims, but having somebody to be a claim adjuster and pay these claims right now.
Mm-hmm.
Yeah.
So it sounds like there'll certainly be delays as with probably many steps of this process, but
Yeah,
you know,
yeah.
the claim paid.
Now, now other companies who have less saturation in those areas, I mean, they've got 3 claim adjusters on these losses, and they're paying stuff pretty quickly right now. So, as long as the carrier has the capacity, they're going to do the right thing, and they're going to do the right thing as fast as they can.
Can you just expand a bit on, you know, the claim adjuster process? What does that look like? Are there any tips that you have for people as they go through that process in terms of
Sure.
getting, you know, an unbiased opinion?
So, I kind of referenced this earlier. There is the contractual obligation, but then there's what insurance companies are doing now in these total losses. In the contractual obligation, there needs to be somebody that goes out there, does an inspection of the property, does an estimate, that kind of thing. It's a bit more involved. What I am seeing some insurance companies do right now is they're looking at the aerial photography. If they see a total loss, they'll just pay that out for that. What I will say for somebody that such as maybe the people that are listening uh, to this call or webinar right now, is in a perfect world, you would have an inventory of your personal contents. You'd have a spreadsheet with your items and the value of it, but we're not in a perfect world. So the next best thing is to go around the residence and video record everything. Make sure to open up those cabinets, open up the closets, video record everything and upload it to the cloud. I believe Beacon has like an online vault where they can maybe send that. You can confirm that with me, Julia, where they can send it, and you guys are happy to keep that information should there be a claim. So that's going to help you in making sure that you collect that personal property limit under your policy. Make things a lot easier, especially for artwork that you may have in the house.
Sure. Can you speak to anything specific to California? For example, any upfront payments that carriers are required to make?
Yeah, so I'm hoping most of you won't have to confront this, or I'm sure I'm not saying most of you, most of anybody that's had a claim, and the insurance company is going to do the right thing. But the Department of Insurance is requiring that that an insurer is paying at least 30% of the dwelling coverage for personal property without needing any documentation. And so, here's a check for 30%. And as I mentioned before, a lot of insurance companies are doing more than that. The other one is additional living expenses. The Department of Insurance is requiring that at least 4 months is paid up front for a total loss in additional living expenses. Having said that, it just came to me right now, is a lot of people have additional living expenses. That's a dollar limit. Nothing wrong with that. A lot of people have that. It varies. It's 50%, 40% of the dwelling coverage sometimes. But with these catastrophes that are going to be a long time, although you are entitled to have living arrangements that are similar to what you're living now, that individual may want to lower that a little bit just to have that money last a little bit longer. For those that have like a bit broader policy that may not have a dollar limit, may have a time limit, you're in luck. There's that protection, as well as the Department of Insurance is making some of them extend that time limit. And some very high-end level policies have no limit at all. But for the most common individual, there is a dollar limit on the policy for additional living expenses.
Okay. Let's shift and talk a little bit about, and as you mentioned, Fred, we're going to be sharing a summary sheet with everybody after this call that goes through all the different types of coverage and the definitions and what actually is included there. But let's take some time and speak about coverage C, which is personal property. So, we've gotten questions around, expensive items within the home. Are those included? Expensive furniture as an example.
Sure.
How would you break down the definition of personal property, and when does it make sense to itemize that coverage, and kind of go into the
Yeah.
specific details inside the home?
Uh, I believe I used this analogy earlier in the conversation. It's kind of silly, but it helps get the point across. If you turn the house upside down, whatever falls out, that would be the personal property coverage. Refrigerator, furniture, anything like that. Just let's say you've got a really nice couch that's worth like $5,000. That's going to be covered up to that limit. Um, there are certain sublimits under the policy. Now, there's several, but the main key ones, the main one, in my opinion, is just one. It's jewelry. There's just a little bit of jewelry coverage under the policy. Some other ones are, silverware, uh, china, precious coins. Those have sublimits as well. But the ones that people fail to understand is the jewelry. There's just a little bit of jewelry coverage, tends to be 1,500. So that a nice engagement ring or that nice watch, if it gets lost or stolen, that's not going to be covered in under the policy by default. So what you want to do in those situations is schedule them. The nice thing about scheduling is that they're covered for mysterious disappearance. So if you're in France on a vacation and you lose that engagement ring, the insurance company will help you replace that. So it's definitely beneficial. Now, most policies do not have a sublimit for artwork. Some do. So it's important to understand that. But in either case, whether it is or there is not a sublimit for artwork, it's good to schedule that. The reason is when you schedule it, you're predefining the value of the artwork, and if you don't have that um, uh, until after the loss, it becomes a real pain trying to prove that that piece of artwork was worth X amount of dollars.
Understood. And so if I understand you right, the way that the sublimits work is if you had a $1,500 sublimit for jewelry, as an example, once you meet that coverage or sub-coverage limit, that you're no longer going to be reimbursed for any jewelry inside the home, exceeding that figure. And then
Yeah.
the total personal property limit, though, applies. It will just apply to other items within the home, correct?
Yeah, and it gets worse than that because the deductible applies to it. So if you had a $5,000 deductible and you only lost a ring, there's practically no coverage for it. Now, some people may be wondering, why is there a sublimit for jewelry? Um, you know, you know, all I'm hearing right now is fire losses. But in the past, when there's a burglary or theft claim, it's not that they stole the TV, they didn't steal the couch, is they stole the jewelry. And so being that they are a high theft item, if the policies insured them for 100%, the cost of the insurance would just be unattainable.
Okay, that makes sense.
Yeah.
So with that, I'm going to, I know you have, 5 takeaways for clients that we're going to go through together, which are really helpful. But we have a few minutes here. I'm going to take a look at the Q&A for some questions that have come in,
Okay.
and let's do our best to address at least a couple. Is there a difference between homeowners insurance and insurance for a condo complex? And if so, can you walk us through the differences?
Yeah. So a homeowners association will insure typically the outside of the structure, and the condominium policy will cover the interior of the structure. So the condominium policy will cover the flooring, the kitchen cabinets, your liability, as well as your personal property. So because the HOA is covering the structure, the condominium covers the interior. Um, the CCNRs, the codes, covenants, and restrictions, they're all different, but I'm talking in general terms. The HOA covers the structure, the condominium policy covers the interior.
Okay. This is also one here that I've heard many times. How does land value come into the equation here? How would you kind of speak to that part of the equation?
During the rebuild process, it's a non-issue. We don't, insurance company doesn't care. They just care about, the materials used to rebuild the property and how much it's going to cost to rebuild. When it becomes a hot topic is when you want to purchase another property. In other states, the insurance company is allowed to subtract the cost of the land when paying out the claims, but fortunately not in California. So that can be included in the claim settlement is the cost of the land of purchasing another property.
Okay.
Yeah.
Okay. And I think you touched on this early on, but let's reiterate it for those that may have missed it. The difference between dwelling coverage, rebuild cost, and replacement cost. I know that these words get thrown around quite casually. Can you just
Sure. What was the third
summarize
one?
that again?
What was the third one?
Replacement cost.
Okay. Uh, so the rebuild and replacement, they are used interchangeably. Replacement cost, what is important in that definition is that they don't subtract the depreciation of it. So for example, if you're, I'm just going to use a couch because it's simpler than a house, is if your couch got destroyed, instead of giving you money for an old couch that was similar to you one, they'll give you money to get you a new couch. So that is what's called replacement cost. The opposite to that is actual cash value. Now, most of you on this call, I'm hoping will have replacement cost coverage under the policy, where it's going to be enough to money to get you the new stuff. They won't subtract any depreciation. Then we talked about the extended replacement cost. There's that extra buffer in case of catastrophic events. But rebuild, it's not a term used in insurance, but in practical terms, it's used interchangeably with replacement costs.
Okay. Okay. And so you again, kind of bifurcating the decision tree here, you have the decision to rebuild the home, you know, and they'll pay out over time for you to rebuild your home, correct? Right? That's typically how the process is.
That is the contractual requirement. In these times right now, the insurance companies are rightfully choosing to pay out the limits in most of those cases upfront.
Okay, so often you're seeing them pay out in one lump sum.
Yeah, in these times, if your house, prior to a couple weeks ago, if it was just one house that burned down, that process would be a little bit different. In that, as you
Okay.
mentioned, there would be paid as the progress of the rebuild happened.
Understood.
Yeah,
Okay.
yeah.
Okay. Okay. Shifting to the when we were talking about personal property, when we've talked about sort of itemizing or scheduling, what is that? What's involved in going through that process? Do you need to get appraisals? Kind of, can you speak to the process there?
Sure. That depends on the insurance company. There are some insurance companies that require appraisals if an item is over $5,000. Some require appraisals only if an item is over $100,000. For those items that do not require appraisals, talking jewelry specifically, knowing the 4 Cs. Now, ladies probably remember these more than I do. Cut, clarity, carrot, and I always forget the fourth one, but there's 4 C's that you want to know. That's included in important description of the jewelry item. If you get an appraisal, that's always the best thing. Appraisals can be expensive. What I always advise people is usually the seller is nice enough to provide an appraisal or an updated appraisal, and usually they do that at no cost to maintain goodwill with the consumer.
Okay. Okay. Thank you. So last request or question, I think this will be helpful for people joining. Can you share your top 5 tips, given your experience, to help, people feel better prepared moving forward?
Sure,
What
sure.
would be 5 tips?
Sure. And I will bet that some of you probably saw this topic on social media in regards to the trust on the homeowner's policy. You've heard that if you don't add the trust, there's going to be a declination. So it is important to add the trust onto the homeowner's policy. How you add it varies with insurance companies. Sometimes it's a named insured, sometimes it's a co-insured, sometimes it's additional insured. Don't worry too much about that. Have your agent add it the best way that they can. Now, in the situations with the claim, say, I forgot to add the trust, is my claim going to get denied? As long as the named insured is tied to the trust somewhere, like they're the trustee on the trust, they're going to pay the claim. What gets tricky is that if the trust has nothing to do with the named insureds and they're trying to have difficulty finding insurable interest, that can get a very difficult area. But I'd like to think insurance companies will do the right thing and pay those claims in those situations anyway. So anyways, that is my point, is make sure that the trust is included on the insurance policy. I had one yesterday where the trusts were added to the vehicles. I'm not exactly sure of the estate planning involved behind this, but if that's the case, we want to make sure that the trust is added onto the auto insurance policy as well. A lot of rental properties are being titled to LLCs. That's perfectly fine. Just make sure that LLC name is included under the rental properties. I don't see those LLCs being included onto owner-occupied properties, mostly rental properties. And that's fine. As we mentioned earlier, be sure to schedule jewelry. As I mentioned, when I get that phone call, there's a theft claim. They didn't steal the television. They didn't steal anything. They stole the jewelry. So make sure that that's covered. Or maybe you're not concerned about theft. Maybe you're concerned about lost items. And kind of going back, a simple thing, just go around the house, video record everything, upload it to the cloud. If you don't know how to upload it to the cloud, Beacon Point has that online vault. I'm sure they can help you figure it out where you send it to them and they'll save it on there. And people's personal property changes. So, and being that it's pretty simple to record things, update it every year. And as always, have a conversation with your agent. I get very busy. Sometimes it's very hard, especially nowadays, to have that a refresh conversation with the client. But squeak wheel gets the attention. So ask, hey, can you please go over my dwelling coverage to see if it's sufficient? I've got, I know we're focused primarily on property coverage, but I can say with 100% certainty, anybody that's a client with Beacon Point needs to have an umbrella policy if they don't already. And that's very, very important. We can have a whole another webinar about that, but I'm going to plant the seed so you can ask about that with your current agent, or even ask your planner about that. Funny enough, planners are better salesmen at umbrella. Even they don't get any money off it, but they're better salesmen at it than I am, simply because they understand the assets that are at risk, and just that one liability claim that'll just wipe it all away. And for what the umbrella costs, just a couple $100.
Makes sense. Thank you.
Yeah.
So I appreciate it, Fred. You know, I think those 5 takeaways are important. And with that, you know, I'll shift and simply say we hope that this was informative for everybody. We're here to support you, and you know, this was a starting point, right? We wanted to make it digestible, and hopefully, you know, these questions gave you a foundation where you feel a bit more informed. There's certainly a lot of nuance, right? And carrier specific language, policy specific language, and those details really matter, right? So please reach out to your Beacon Point advisor if you want assistance in reviewing the policy. We can, you know, use our network, you know, Fred is an example of that, to review and provide more detail and specific guidance, right, as to your specific policy, and kind of dive into the details here of you know what your coverage looks like. Finally, you know, for anyone that submitted questions, we were able to address a few of them today. But please know, you know, we will get back to you personally, one-on-one, to go through any that we missed. And I'll also say we have, I've mentioned it a few times, a summary sheet that will go through different types of coverage, the definitions. Really, really helpful. I think everyone will get a lot of value out of that, and we'll be sharing that with all of you after the call today. So thank you all for taking the time. Thank you, Fred. And we hope you all have a good rest of your day.
Thanks, Julia.
Thank you.